Hello and welcome to the second lesson in the JCA Corporate Credit Risk Training. We are continuing to review the 4 key concepts that develop the right mindset for credit risk. We are going to cover number 2 in this lesson, which focuses on the role of accounting. Accounting, financial reporting, and the resulting financial statements capture the financial impact of all business level activities. In the first lesson, there was emphasis on understanding that a company or potential borrower is really a system of activities that are separate, distinct, and require a specific mix of people, technology, and operating assets. In our example for Wal-Mart, we established that the company is a system of support activities including financial planning, human resources, and information technology, and primary activities including procurement, logistics, operations, marketing, and service. Within the primary activities, there were key points that were unique to it as a company, and other primary activities and key points that would be similar relative to its peers, Target and Costco. In this second lesson, we are going to connect Walmart's activities to its income statement, the financial statement describing how profitable a company's activities are. This lesson is to ensure that you are viewing the financial statements in the right context. From a revenue perspective, it's important to understand that essentially all activities, even support activities, play their role in allowing a company to generate revenue. For example, let's think about just financial planning. Consider the FP&A teams that provide the data or analysis to determine where to open stores, the projected operational and financial goals going forward, or how to fund a company's day-to-day investments. Similar, very important functions are performed by human resources and information technology. For revenue generation, it cannot be overemphasized how primary activities play a key role in generating revenue, as these primary activities touch the product, touch the service, or touch the value that is created for Walmart's customers. From a cost perspective, across all types of companies, and not just a retail company, support activities are often captured in selling, general, and administrative expenses. In Walmart's case, its procurement activities and logistic activities are captured by its cost of sales. Common for a retailer because these activities and costs are directly related to acquiring products and transporting products to a location readily available for customers to purchase. Therefore, these activities are the direct costs to generate revenue. Below is Walmart's disclosure for what activities and costs are captured within its cost of sales figure. Operations, marketing, and service are also captured in selling, general, and administrative expenses. Although these activities and costs are considered primary from an operational or value perspective, these activities and costs are not directly related to acquiring the products nor transporting products to a location readily available for customers to purchase. Walmart's income statement for revenue, costs, and operating income are only 8 simple lines. Hopefully now you have a better grasp that these 8 lines capture its entire business. In fiscal year 2019, Walmart's primary and support activities combined to generate $21.957 billion in operating income. This is crucial to understand as the company's business level activities become quantifiable for management, creditors, investors, and regulators. Walmart's income statement is an important element to its credit risk, but is only the first step to understanding the operational story for the previous 3 fiscal years. Moving on, it is important to consider that accounting is both systematic and rules-based. However, there are 2 important considerations to keep in mind. Number 1, accounting rules are not always applied consistently. And number 2, accounting rules and disclosures are left to management's interpretation. Below are 2 disclosures from Target and Walmart regarding their cost of sales figure. By reading these excerpts, you will see that Target includes the activities and costs from its 40 distribution centers within its cost of sales figure. In comparison, Walmart does not include the activities and costs from its 156 distribution centers within its cost of sales figure. This is an example of accounting rules being applied differently by 2 different management teams, and the same cost of sales metric being presented differently to creditors and investors as well. To finish up, do not view financial reports as simple numbers on a page. Also, do not fail to understand that the company's or potential borrower's financial statements capture the financial impact of all business level activities. In the next lesson, we will cover the third concept, which focuses on the idea that analyzing loans and debt are the true goal of credit risk.